Before we begin our investigation, a quick reminder. All information in this video is for educational purposes only and is not financial advice. The markets are closed. On screens around the world, one number is frozen in time: $67.14. That is the official closing price for silver on Friday. But do not let the silence deceive you. This is not calm. This is the quiet before the storm. What happened on Friday was not just another day of games. It was a historic event. A 40-year-old price suppression algorithm was broken. The level that was considered an unbreakable wall has fallen. And this breakout, as my investigation shows, was not a victory, but a declaration of a final showdown. Right now, this weekend, while we are relaxing, a quiet panic is gripping the boardrooms of the largest commercial banks on Wall Street and in the City of London. Their phones are ringing off the hook. Those are margin calls, demands to post billions of dollars to cover the losses on their giant short positions. Money they may simply not have. They are trapped, and they have until Monday morning to find a way out. Monday is their deadline. The day they will either have to concede defeat and begin panic buying their paper contracts, triggering a price storm, or make one last, desperate move to try and regain control. You are on New Era Economics. In this emergency weekend update, we will conduct a full analysis of the disposition of forces before this decisive event. Like strategists, we will look at the playing field, assess the strengths and weaknesses of each side, and break down the most likely scenarios for what will happen on Monday. This is not a prediction. This is preparation. To understand what might happen on Monday, we must first soberly assess the forces that brought us to this point. Let's analyze the disposition of the bulls, those who are betting on a price increase. Subscribe to learn more. Our investigation is just getting started. My research shows that their position is stronger than ever, resting on three powerful fundamental forces. The first, and most relentless force, is physical arbitrage. It's a complex term for a very simple idea. Money always flows to where it is treated best. Right now, with the price on the COMEX in New York closing at $67, the price on the Shanghai Gold Exchange, where they trade real metal, is the equivalent of $72. This $5 difference is a giant magnet. It screams to every bullion owner in London and Zurich, do not sell your metal in the West. Ship it to China, where you will get 7% more. This is not a theory. This is what is happening right now. We are seeing reports of record outflows of metal from the LBMA and COMEX vaults. It's a giant vacuum cleaner, sucking all available physical silver from the west to the east. This means that if the banks try to find real metal on Monday to cover their short positions, it simply won't be there. It's already on a boat to Shanghai. The second force is the industrial front. Unlike gold, which can simply be stored, silver is a workhorse that is consumed irrevocably, and this demand is becoming more and more desperate. My analysis of recent news and reports shows that we have entered a new phase. The largest industrial consumers, electronics manufacturers, solar panel producers, EV makers, no longer trust the exchanges. They understand that the paper market is an illusion that could vanish at any moment. Therefore, they have begun to act. We are seeing more and more reports of these companies signing long-term off-take agreements directly with the mining companies. What does this mean? They are guaranteeing the purchase of a mine's entire future output for years to come, before it is even extracted. They are, in essence, cutting the exchange out of the supply chain. Every such contract represents millions more ounces that will never hit the open market and can never be used by the banks to cover their paper debts. And the third, and perhaps most powerful force right now, is the psychological advantage. For 40 years, the silver price chart was a battlefield where every bull offensive ended in defeat. The 65-67 level was that unbreachable fortress. But on Friday, that fortress fell. This completely changes the psychology of the market. All the computer algorithms, all the technical analysts who used to see this level and signal sell, now see a breakout and are signaling buy. The 40-year bearish trend is broken. Everyone who was sitting on the sidelines, waiting for confirmation, just got it. On Monday, they will be coming to the market not to sell, but to buy. So, what do we have on the side of the bulls? Relentless physical arbitrage draining metal to the east, desperate industrial demand claiming it before it's even mined, and a powerful psychological shift that has turned former skeptics into new buyers. This is a formidable force waiting for the opening bell.
We've analyzed the army of the bulls.
But to understand the outcome of the showdown, we must look inside the enemy camp. What is happening right now on the side of the bears? The commercial banks that have been betting on a lower price for years. My investigation shows that their position is not one of strength, but of desperation. Their main problem is the short position trap that has just snapped shut. As we've established, their combined net short position is hundreds of millions of ounces. As long as the price was below $65, this position was either profitable or manageable. But after Friday's breakout, it has turned into a financial black hole, sucking billions of dollars from their balance sheets every hour.
This weekend, they received margin calls.
This means that on Monday morning, they must either find billions of dollars in actual cash to post as additional collateral, or begin buying back their short positions. But as we already know, there is almost no physical metal left in the West. Any attempt at a large-scale purchase in the market will trigger an even bigger price spike, which only increases the losses on their remaining positions. They are in a no-win situation. They need to buy something that isn't there, and any attempt to buy it makes their situation even worse. They are trapped, but a cornered animal is the most dangerous. And my investigation shows that they have one last card to play. One desperate attempt to turn the tide, which they will most likely make on Monday morning. This last card lies in the options market. There is a concept known as max pain. This is the price at which the maximum number of options contracts, both calls and puts, expire worthless, generating the maximum profit for their sellers. That is, the very same banks. I have analyzed the open interest data for the end of the week, and the max pain price for this month's expiring silver options is at approximately $64. What does this mean? It means the banks have an incentive, measured in the hundreds of millions or even billions of dollars, to launch one final, coordinated, paper intervention to try and smash the price from 67 back down to 64, even if just for a few hours. This would allow them to zero out the maximum number of options, minimize their losses on that front, and, more importantly, create the appearance of a false breakout on the chart. They want to scare the market, make everyone believe that Friday's breakout was a fluke, and trigger a panic sell-off. This is their final move. It's desperate, it's risky, but from their perspective it's the only one they have left. They cannot win in the long run, but they can try to buy time and inflict maximum psychological damage on the bulls in the short term. Therefore, on Monday morning, we are unlikely to see chaotic trading. We are likely to see a direct collision of two titanic forces: the fundamental physical demand pushing the price up, and the desperate paper intervention of the banks trying to smash it down. So, the playing field is set. On one side, relentless physical demand. On the other, the desperate paper maneuvers of the banks. What will this collision look like in reality? My investigation, based on historical precedents and the current setup, points to two primary scenarios that are likely to play out on Monday morning. Scenario number 1, which I call the morning storm, is a gap up and the beginning of the short squeeze. This scenario assumes that the forces of the physical market will prove stronger from the very start. The showdown won't begin in New York, but hours earlier, when the Asian markets open. Traders in Shanghai and Mumbai, seeing Friday's breakout in the West, will begin aggressively buying up all available silver to press their advantage.
By the time the New York market opens, the price may no longer be $67, but $70 or higher. This is called a gap up. For the banks holding short positions, this is the ultimate nightmare scenario. Their weekend losses will instantly materialize and magnify. Risk management systems will force them to immediately begin buying back their short positions at any price to stop the bleeding. This will trigger a chain reaction, the very short squeeze everyone talks about. We would see incredible volatility and possibly multiple trading halts. Presenting the second scenario with a brutal tone. Scenario number 2, which I call the last stand, is the bear's final move. This scenario assumes the banks will try to use their last remaining trump card,
the options expiration. In the very first minutes or hours of New York trading, they could launch a coordinated dump of a massive number of paper contracts to artificially crash the price. Their goal would be to drag the price down to that max pain level of $64. This would look like a sudden and brutal collapse. A long red candle would appear on the chart. The financial news would scream, "The breakout was false! The bubble has popped!" This would be designed to induce maximum panic in the weak hands, forcing them to sell and helping the banks cover their shorts at a lower price. This would be their last, most desperate attempt to regain control.
What conclusion does this lead us to? Regardless of which scenario plays out in the first few hours, an explosive rise or a sharp fall,
it will mean the same thing. This is not a return to normal trading. This is the beginning of the final phase of the showdown. Either the bulls will immediately break through the defenses and trigger a panicked retreat of the bears, or the bears will launch a final countermove that, even if successful in the short term, will only deplete their last reserves and make the subsequent breakout even more powerful. In either case, the quiet times are over. Knowing the possible scenarios, the main question is how to act. My goal is not to give you financial advice. My goal is to share with you the strategic principles, based on history and market psychology, that will help you maintain clarity of mind in the eye of the storm.
Principle number 1.
Do not buy into euphoria. Do not sell into panic. This sounds simple, but on Monday it will be the hardest thing to do. If scenario 1 plays out, and you see the price explode towards $75, your brain will be screaming, "Buy! You're missing the move of a lifetime!" This is FOMO, fear of missing out, in its purest form. But history teaches that professionals never buy into a vertical spike. They bought on weakness during the quiet periods. Buying at the peak of euphoria is the surest way to become the last fool in. Conversely, if scenario 2 plays out and you see a sharp crash to $64, your brain will be screaming, "Sell! It was a trap! I'm going to lose everything!" This is pure panic. But as we've already established, such a move would only confirm the bank's desperation. Selling into a moment of artificially created panic is a guaranteed way to hand your asset over to the smart money at the lowest possible price.
Principle number 2. Watch for the retest.
The strength of a breakout is not determined by how high it flies, but by whether it can hold the territory it has conquered. Therefore, regardless of what happens in the first few hours, the key moment will be the retest of the $67 level. If the price soars to $75, and then, over the course of the day or week, comes back down to $67 and bounces off it, that is a powerful confirmation signal. It means the old ceiling has truly become the new floor. This is the moment when conservative investors might consider entering a position. If, on the other hand, the price falls to 64 and then rallies back to 67 but fails to break through it from below, that will also be a signal. a signal that the bears have exhausted their strength and the bulls are back in control. Principle number 3, and the most important, physical metal is your fortress. Understand this. All of this drama, the gaps, the squeezes, the maneuvers, is a fight in the world of paper illusions. It is the agony of the old system. If you own physical silver, you are not a participant in this fight. You are an observer, watching it from the walls of an impenetrable fortress. The price on the screen may jump by 10% in a day, but the number of ounces in your safe remains unchanged. 1 ounce is always 1 ounce. Do not let the noise of the paper showdown make you surrender your fortress. Your job is not to try and catch every dollar of the move. Your job is to preserve a real asset until the paper system exhausts itself and the great decoupling that we've talked about begins. You have already made the most important move in this game. Now, you just need to have patience. And so, our emergency briefing comes to a close. We have analyzed the strength of the bulls and the desperation of the bears. We have considered the likely scenarios and armed ourselves with strategic principles. Whatever happens on Monday morning, whether the price explodes to the upside or faces one last desperate maneuver, the outcome is already determined. This weekend is not just a pause in trading. It is a historic moment when the balance of power in the silver market has, perhaps, shifted forever. The showdown on Monday will only determine the speed, but not the direction. The direction has long been set by the relentless laws of physics and economics, the laws of a real, physical deficit. With a powerful concluding metaphor. The old system, built on the illusion of infinite paper supply, is crumbling before our eyes. Our job is not to try and catch every falling piece of that crumbling wall, nor to participate in its agony. Our job is to calmly watch this process from the safety of our own ark, an ark built of real, tangible assets. Brand-defining, confident. You are on new era economics. We don't predict the future. We decode the blueprints of the past to be prepared for it. If you found this strategic analysis useful, subscribe. The fight for silver is entering its final phase, and we will watch it unfold together.